Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. The Dow shatters all-time records, but a shadow war erupts as capital flees tech for safety. Is this a historic rotation or the prelude to a tech bloodbath? Second, alarm bells. Foreclosure surge masks a deeper crisis as FHA delinquencies skyrocket 11%. Analysts say, don't worry, but a hidden canary in the coal mine is screaming danger for millions of homeowners. Is a new kind of housing trap about to spring shut? Finally, Oracle's AI dream becomes a nightmare. Stock plunges 33% as a credit crisis looms. The blockbuster OpenAI deal that fueled a record surge now reveals a profitability mirage. Is Oracle's high-stakes gamble about to trigger a domino effect, ending the AI chip boom? Listen up, we're in a market moment that will define your portfolio's fate. The Dow Jones Industrial Average just shattered records, soaring past the 48,000 mark for the first time ever, closing at 48,254.82. Meanwhile, the Nasdaq's retreat by 0.32% signals a seismic shift. Money's fleeing high-growth tech for the safety of financials and industrials. I'm telling you, this is a pivotal day. Don't sit back and watch. The S&P 500 edged up to 6,850.92, barely clinging to gains while the Dow celebrated. It's a clear indicator big money is betting on a rotation. Institutions are parking cash in dividend-paying blue chips, leaving tech to fend for itself. Fed rate cut expectations are now a coin toss at 50 to 54%, and with the delayed CPI data due to the 43-day government shutdown, the uncertainty is through the roof. The calm on the surface hides the storm brewing beneath. Watch out! The Fed's next move is up in the air, with December's decision hanging on incomplete data. Jerome Powell has already hinted that a rate cut isn't guaranteed, and with inflation figures delayed, the Fed's flying blind. The market's recalibrating. Financials are thriving on the current rate environment, and industrials are set to benefit from the government reopening. But tech, it's taking a hit as valuations get squeezed by higher rates. The 10-year Treasury yield hovering above 4% is a warning growth. Stock multiples are under the gun. Strategically, you need to act now. Rotate out of overvalued tech and into financials and industrials. The Dow's rally is your signal. Listen to it. Maintain a slight overweight in financial services and industrial equipment manufacturing. The Nasdaq's weakness is a flashing red light. Cut positions trading at forward P divided by E, multiples above 35 times. If you're holding tech with negative free cash flow, it's time to trim down. Sector-wise, the financials are leading the charge up as the shutdown resolution eases recession fears. Disney's earnings miss hit its entertainment arm hard, but its parks are a goldmine. Cisco, on the other hand, beat expectations with strong networking growth and got a fair value boost to $67 from Morningstar. This is where you want to be. The XLF and XLI ETFs are your go-tos for capturing this shift. Meanwhile, watch the tech-heavy QQQ closely. If it breaks below 420, brace for a deeper tech correction. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. In the short term, reduce your tech exposure by 12 to 20% and redeploy into financials and industrials. Cut META and MSFT. Immediately rotate into XLF today. Over the medium term, watch for the 10-year yield to rise above 4.3%. If it does, reduce growth stock exposure by another 10 to 15% and increase defensive sectors like utilities with XLU. For a defensive hedge, grab some consumer staples via XLP. It's your shield against inflation surprises. Risk control is non-negotiable. If the 10-year yield drops below 3.9% or the Fed signals a December cut, reverse course and reallocate back to tech. Advanced investors buy put options on QQQ at 420 strikes. Intermediate players consider sector rotation into XLF while trimming tech. For the basics, increase cash positions and wait for a pullback. Remember, the next big data drop is the delayed CPI. When it hits, it could swing the market's mood. Keep your eyes peeled for Fed commentary and market reactions. Time's ticking. Let's dive deep into today's critical market dynamics. Cracks are appearing in the housing market. New data shows foreclosure starts just shot up 20% year over year, with completed foreclosures jumping an even steeper 32%. This marks the 8th straight month of annual increases. Now, some market analysts are saying there's no foreclosure tsunami to worry about, pointing out that overall numbers are still below the historic average. The thinking from those analysts is that foreclosures are a lagging indicator reflecting distress that has already happened. From this perspective, the current rise is just a return to pre-pandemic norms after government support ended. They believe the market can absorb this, but that's not the whole picture. The real turning point is found in a specific corner of the market. According to one real estate intelligence firm, Federal Housing Administration, or FHA, delinquencies have soared to over 11%. The reason this specific data point is getting so much attention is because FHA loans are designed to help lower income households. Because these borrowers often have thinner financial cushions, their loan performance acts as a leading indicator, like a canary in a coal mine. It signals trouble for the broader consumer credit cycle long before it shows up anywhere else. Believe it or not, it gets even more concentrated. Those FHA loans now account for a staggering 52% of all seriously delinquent loans in the country. And here's where the contrast becomes clear. The serious delinquency rate for conventional loans is just around 0.55%. The fact that the FHA rate is so much higher highlights the disproportionate pressure on households most vulnerable to economic shocks. This concentration of risk is flashing a major warning sign, especially in states like Florida and Texas, where falling home prices and soaring insurance premiums are creating a toxic combination. To see how this plays out, just look at Tampa Bay, Florida. A few years ago, home insurance was about 4.8% of a mortgage payment. Today, it's nearly 15%. This surge dramatically inflates monthly costs and pushes homeowners to the edge. And this isn't happening in a vacuum. Consumer debt is at an all-time high, other credit delinquencies are rising, and the job market is weakening, all mounting pressure on recent buyers locked into high mortgage rates. This exposes a new kind of vulnerability. In the past, homeowners could escape high rates by refinancing. But for the wave of buyers who bought after 2022, their rates are so high that refinancing isn't an option. This refinancing squeeze traps them with high payments, challenging the belief that fixed-rate mortgages insulate the US housing market from Fed policy. While the broader market has held up so far, one expert put it bluntly, stating it would be unrealistic to assume these trends won't lead to an increase in defaults in the months ahead. The data suggests the pressure is accelerating. So where do we go from here? The main question is whether this distress translates into a meaningful increase in housing supply. Actually, even with a rise in foreclosures, the impact on overall inventory might be minimal. Demand for lower price homes remains incredibly strong, so these properties will likely get bought up very quickly. This means the fundamental problem of affordability won't be solved, which could keep pressure on rents and complicate the fight against inflation. Therefore, the FHA delinquency rate and regional insurance costs will be critical to watch in the coming months. This content is for informational purposes only and does not constitute financial or investment advice. Market conditions are volatile and subject to change. Speaking of hidden risks bubbling under the surface, a very similar story is playing out in the high-flying world of AI, centered on Oracle. Just 2 months ago, its stock had its best day since 1992, soaring 36% to a record high. Today, it has lost 1/3 of its value, on pace for its worst month since 2011. The initial hype was fueled by a blockbuster deal with OpenAI, reportedly worth up to $300 billion. But now, the mood has turned. As one KeyBank analyst put it, AI sentiment is waning. This is where the situation takes a more complex turn. So the thing is, not all revenue is created equal. This is what some are calling the AI profitability mirage. To put it in perspective, Oracle's traditional software business has gross margins over 80%. By comparison, this new AI cloud business is projected to have margins of only 30 to 40%. That massive drop in profitability is forcing a total reevaluation of the company's worth. And as we've noted, if AI hardware churns faster than accounting assumptions about useful life, those reported profits can evaporate in sudden write-downs. Investors are now questioning if Oracle can even afford its massive AI ambitions. The company is reportedly trying to raise $38 billion in debt to fund its data center build-out. That heavy reliance on debt has credit analysts on high alert. One analyst at Barclays downgraded Oracle's debt, writing, "We struggle to see an avenue for ORCL's credit trajectory to improve." Now get this, the cost to insure against an Oracle default, known as credit default swaps, has climbed to a 2-year high. These swaps are basically financial insurance policies. When the price goes up, it's a clear signal. The market sees higher default risk. And this isn't just a drama about one company. It could be a leading indicator for the entire AI investment boom. We've seen this movie before. Rising debt in a capital-intensive tech cycle starts to rhyme with the late 90s fiber optic build-out that ended in painful write-downs. We could be seeing the first credit crunch of the AI era. While bulls point to founder Larry Ellison's track record, critics are getting louder. An analyst from DA, Davidson, called Oracle's strategy the bad behavior in the AI build-out, contrasting its debt-fueled expansion with cash-rich rivals like Microsoft, Amazon, and Google. What's fascinating is that there's a specific term for this borrowed from real estate: anchor tenant risk. Imagine building a mall where 90% of the income comes from one store. If it leaves, the mall could go bankrupt. Here, Oracle is the mall and OpenAI is its single massive anchor tenant. A pivot by OpenAI could trigger a domino effect, a danger that doesn't really exist for diversified cloud providers. Ultimately, it all comes down to whether Oracle's massive gamble will pay off. Looking ahead, the first thing to watch is the ripple effect on the semiconductor industry. If Oracle's debt problems signal a slowdown in capital spending, it could be a leading indicator of a future GPU glut. This would challenge the growth story of chip makers like Nvidia and could signal a peak in the market's rally. After all, if budgets roll over now, that air pocket in demand only gets bigger. Secondly, this might accelerate sovereign AI initiatives elsewhere. A cautious US capital expenditure cycle could push the EU and China to double down on domestic AI to avoid dependency on US corporate decisions, potentially fragmenting the global AI market. For now, Wall Street is saying the AI euphoria was a mirage, with one analyst concluding it makes a lot of sense that that's completely gone away.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.